And before founding TechSquare Ventures, I spent most of my career building and leading technology companies. So I went to Georgia Tech, and after a brief stint in financial services, working for a company called SEI on Wall Street, jumped out and started a company in the early internet days. You know, when I started school at Georgia Tech, there was no web browser. And right when I finished was when, you know, Mosaic and Netscape and all that released. So I came out of college just at an amazing time, and really got the bug while I was working in financial services, and launched a company that was really building web applications for other companies. And we wound up merging with another startup, and we eventually grew that company and took it public. And I ran everything outside the U.S. for that company. So scaled that from day one through a publicly traded company. I went on to found another early stage software company. And it was, today you would call it a content management software company. Those words didn't exist then, but it was the platform that things like WebMD and what's now AutoTrader launched on. And then I was a hired CEO of two other venture-backed companies. One was a prepaid card company. The other was a SaaS software company, which we sold. So I've spent most of my career building early stage technology companies and now investing in them. And so look forward to sharing with you some advice on the importance of having a solid financial plan and how to communicate that to investors.
Yeah, that's great. I think, so actually Blake is an expert on these markets, I think, and also from the VC side. That's why we thought we'll share. And the plan, I think, in terms of the presentation, what we thought we'd do is probably I won't take too much of my time in my, the first 20 or 30 minutes. I would actually go through the financial models. And then again, as I've seen many of the financial models that you have done, there's some dispersion, but many of you have done a good job. So, and you already have gone through the local competitions. So I don't want to go through the basics of that, but broadly give an overview, some things to keep in mind, and some takeaways. That's what we want to do for around 20 to 30 minutes. And then Blake will actually spend probably another 40 minutes going through the ask, so that you have a fair understanding of how venture capitalists, when you approach it, how they perceive that, what are the best practices for that. And then we are going to do a breakout exercise. I think that's important as part of your pitch later. This will give you some experience, but what we want to do also is for you to give a overview of how it looks. Are you able to translate your vision, your business in a very short time, in 5 minutes, I think, to another team? And then we want to come back and again, look at whether there's anything that can be done differently based on the experience. It's the initial thing, think of it as a practice for the next round. You already have done it, but I think before, but this would be one more round of practice. So there's 3 components, and as much as possible, I would like it to be interactive. I understand, I think with the online things, it's going to be a bit less, but we'll try to make it as interactive as possible. I'm trying a couple of slides with some interactive, where you can actually poll, and we'll see how that works out. This is the first time I'm using that. So with that said, let me first go through at the very broad level. Let me talk about, again, financial models and forecasting at a very broad level. So if you look at, I think, the first one, there's a lot of generalities if you think about it, about financial models, right? I think, again, it doesn't, need not have to do with just a financial model for a startup firm. But if you think about financial models for anything inside a large company or for any kind of project, these are very quantitative in nature. So you think about it, take a step back, and then think about it. There's a lot of generalities one can say about these financial models. But are these true? In a way, again, all of you have built these models, but one of the things that I would want you to think about is, again, which ones of these are true? First, I think models by definition are quantitative. Again, you can model a number of items as you've done, right from your revenues to cost of goods sold to your employees to customer acquisition costs. There's a number of them. So it seems very objective. So any of you think that, I think because we do this as a completely quantitative, is it going to be a very objective exercise? Anyone thinks this is completely an objective exercise, the modeling of the financial statements?
I feel like there are going to be a lot of assumptions that we need to make.
That's true. That's the most critical thing, I think, in a way, like as you go through it, the number of assumptions that one makes are going to be like humongous. And ultimately, everything depends on the assumptions. When I teach a valuation class, I tell the students that, I think, give me 2 numbers and I can actually make a company worth $1 million or $1 billion. Just let me change 1 or 2 assumptions and the company value can be anything. It can be worth more than a Google or a Microsoft, or it can be like worth nothing, right? It's all goes back to what the critical assumptions you make and how well you are able to defend them. Again, I have seen, I think, your spreadsheets and you have made some good assumptions, but I don't want to go through each of the spreadsheet and talk about, again, those assumptions, but I want you to make it think through. It's not just because you put together a spreadsheet with many assumptions and it doesn't complete. It's objective, it's subjective, and also part of what you're trying to get to a VC or to any others is how good are your assumptions, right? So that's the one important thing I would like you to, again, think a bit more, and I'll ask some questions about that. The second thing, again, a well-researched and well-done financial model is timeless. You basically do all your work and then you create a very good financial model, a holistic financial model with all the right assumptions. So it's timeless. Is it like, I think, something that would be valuable 6 months down the line? Any of you think it's going to be like what you have done, let's say at the level of the local competition, it's still relevant now? Would it be still relevant maybe like 2 months down the line?
I think as our ideologies change, our assumptions change as well, and our approach changes as well. So it's a working document like our pitch deck.
Right. So it's a working document. That's the way I think about it, because you think about the conditions. It's not only like your own understanding of what's happening, but also the macro environment is changing, right? So right now, just one news about probably the coronavirus, and I think there's a vaccine has come in, it's very effective. It might upend all the assumptions that you're making. Or I think the vaccine is not good. I've seen one of the models about where you are actually thinking about selling to retail industry, right? So if you think about going to the retail industry and then the malls are going to be closed for 6 more months, how you're going to sell, who you're going to sell, what assumptions you make, everything goes for a toss. So I would think of it as a living document, which you need to keep updating as more information comes in. And that information is not only your own learning, but you get to at the macro level. What's happening at the macro level, which includes right now COVID-19 or some other kind of pandemic or some other kind of issues. Again, I've seen like one of the documents, one of the plans is about selling to small businesses. So what do we know about small businesses? What do you expect over the next 6 months or next 1 year? What's the outlook for small businesses? Again, maybe somebody else, I think, who's focused on small businesses.
That was actually me.
Yeah. Okay.
Yeah. It's tough. Selling to small businesses is really tough. Many of them are struggling.
And anyone else, small businesses?
So as the situation, financial situation is not very good in all different parts of the country. So there is a liquidity problem among the small peoples, and large organizations have the balance sheet and retained earnings to survive this tough time. But small businesses don't have that kind of liquidity. So most of them are shutting down. So it will be difficult to sell to a small business. One more point which I would like to add to Mr. Sudhir's
Yeah.
questions, that how relevant is your model 2 years or 10 years down the line. So when we make some kind of modeling for any businesses, and we take all the assumptions, inflation and MCLR and everything, so you tend to make your business case sound enough so that you take all the intricacies into account, so that it gives you at least a holistic picture of next 10 years. Otherwise, how you will depreciate your assets, and everything is depends upon at least 10 years lifetime if you are doing some product, because you have to invest in the capex and all. So you need to have a visibility of next 10 years at least to have a sound business case.
That's true. So like a couple of things. One, I think the stylized fact, I think, is the small business, there's going to be a huge number of defaults in small businesses over the next few months or the next year. Typically in recessions, small businesses are the ones which go out of business more quickly. So what it means is any kind of assumptions, how you are going to sell to them. Right now, when they are in survival mode, whether it's restaurants or other kind of small businesses, for them a new sales, again, how your pitch changes, what assumptions you make changes, how much you ask them to pay changes, how you share revenue changes. So again, one has to keep adopting this one. That's the first thing. And two is, yes, it's true. You want to get to a longer time, or 5 or 10 years. I'll come back to that towards the end. But it's again with understanding that some of this might change. So what you want is build that flexibility into the model. So which I'll mention later, but some kind of scenario analysis. You want to actually stress test your models, right? Your model is just one version of the reality, or one version of things can happen. So you want to understand and showcase to the VCs and other businesses how to stress test your model. If you think about the Federal Reserve, like when it looks at the banks, it basically asks them to forecast how the balance sheets are going to look like when things really go bad, when unemployment hits 18%, 20%. 5 years back, no one thought it's actually possible. They always complained, all the large banks said we're never ever going to see it. And for the first time, I think their worst case scenarios actually came out to be a bit more optimistic than what happened. It's again, going back to the risk, it's not only about the known risk, but also the unknown risk. What is that you don't know? You can't model everything, and you can't put everything into a model, but you want to understand and do some kind of scenario analysis and stress test, so that at least it gives you a sense of how resilient your business model is. Okay, so I'll talk about that later. Finally, I think again, if you think about all these things, some of these points you guys already have mentioned, but it's not necessarily good. It's not a precise estimate of your value. I don't think any VC actually thinks, when you look at the numbers, they think of these numbers as this company, every company is going to break even in year 2, right? Or year 3. Again, I've seen your financials. Anyone goes in, they're not going to say, it's going to take me 25 years to break even. But if every company breaks even in 2, why do we have such a high level of defaults, or high level of exits, how high level of failures among these startup-backed companies, even after getting financing, right? So what it means is not a precise estimate, it's a rough understanding. And it's not necessary the more quantity the model, the more variables you do, it's actually better. Again, you want to keep it simple. Later I'll talk about it, but you don't want to actually like go back and basically have hundreds of variables or tens of variables driving your model. You can basically take in, if you go back to the 2008 crisis, if you think about many of the big companies, large companies which had failed, it's not necessarily because they didn't actually model the defaults of consumers. If you think about, many banks lost billions, hundreds of billions of dollars during the mortgage crisis. They had physics PhDs working for them, math PhDs working for them. And if you look at some of the CDO models, some of the models they have done, the number of, it's very complicated. because they have physics PhDs or math PhDs and who have actually modeled everything. But part of the problem, as I mentioned, is everything, can you model everything? What are the known risks and what are the unknown risks? In a way, they have, and what they've benchmarked all their models, the complicated mathematical models, on a time period when the housing prices were only going up. What it meant was, it useless in a way, because they haven't foreseen a nationwide housing collapse, which basically caused many of these to fail, or many of the mortgages to actually go under, and which cost hundreds of billions of dollars. But the issue is, again, if you have it at the back of your mind, it's better to have a simpler model which showcases the key drivers of what's driving your business. So you get a fair understanding of what is it that's driving your business. Okay. And the last thing, and some of this I'll touch back again on this one. The last thing is, it's not necessarily the outcome that matters. It's not your spreadsheet, however hundreds of tabs you might have. You model a number of variables. It's not the outcome. Think of it as the process of forecasting and modeling, which actually tells you a lot more about your business. It's, in a way, you understand the business more, the interconnections across various parts of your business. That's the key thing. In a way, by doing this one, you're able to understand it. Okay. So again, I'll come back to some of these things, I think, quickly. But the broad idea is, don't, because more quantitative, don't take it, it's a rock solid thing. No, you need to be nimble on your feet. You need to be flexible. You need to update as situation changes. No one asked about, SoftBank never asked about the companies, when are you going to be profitable, right? If you think about it, till around 6 months back, whereas WeWork or some other company, the thing always was, how are you going to grow? We don't care about profitability anytime soon. But what happened right after the coronavirus and other things? The number one thing is, okay, what's your burn rate? When are you going to be profitable? And the runway which companies thought, again, going back to one of the earlier points, we want to forecast for 5 or 10 years, because you think you have a runway of 5 or 10 years. But your runway became from 5 or 10 years, it quickly became 5 months, 5 weeks, right? So if you understand what the key levers, the key drivers of your business, you can see how you can adjust them. That goes back to, again, what I mentioned about stress testing. If one of your assumptions changes dramatically, when things in your control are not in your control, you want to understand, how can I change the other levers so I can actually get back and readjust my forecast. Okay. So what I want to do is, this is something I'm going to try, like, for the first time. I want to, like, yeah, this is again something I basically said. It's not the battle. This is actually Blake's slide. Plans are mostly useless, but you still want planning, because the process of planning makes you understand your business model better. And also it tells you, the VCs and others, have you thought through everything? Have you thought through what drives your business model? Does this entrepreneur have a good understanding of the key drivers? Okay. So quickly, what I want to do is, if you can go to this, I'll come back to this one, but maybe like, actually, yeah, maybe let me briefly go through this one, and then I have a slide where I want you to some feedback. So as I was saying, so far, it's startup financial projections are a work of fiction. They're not only fiction, I think they're probably like much more than that. In a way, it's not something which no one takes it for granted, or saying this is because this startup company has shown this is how it's going to be profitable, we are going to exit in 3 years, right? But as I mentioned, it's again gives you a holistic understanding of things, and it's a conversation for the VC and others to talk about. Think of it as where you have 5-minute conversation. What's the key driver of your business, right? I want all of you to think about it. I'm going to ask a question about it in a minute. I want all of you to think about it, but they can, again, the VCs and others can bring back their expertise and ask you again, why do you think this assumption you're making is reasonable? It starts a conversation. It gives you an understanding of what you're trying to accomplish, and it gives you a way of incorporating feedback. And it also gives you a way of understanding whether all your models are internally consistent. I'll mention this later, but if you think about, let's say like you're expecting to grow sales at 100% every year or every quarter. And you are basically saying we are going to use sales agents, we are going to use others to actually do direct sales. But the assumptions about what is personal costs and how you're going to pay them, are they consistent with your growth forecast, right? So one of the things about your model is it brings some discipline about thinking about, are my assumptions internally consistent? You can't expect your revenue to grow at 100% every quarter and your cost of goods sold and and other things to grow at 2%, right? So the models have to be internally consistent. And when you have goals and milestones, are these again consistent with that? How am I going to achieve these milestones? The assumptions I'm making, the kind of investment I'm making, are they getting me there? Right? So all these things in a way like this, you can browse through, like, because it's just a way of thinking about it, but it helps you to understand what the strengths and weaknesses are, how you're going to finance it, and whether all your assumptions are internally consistent. Okay. So what I want to do is quickly is, this is something I wanted to go to this. Sorry, I think, okay, this is not working. I think the slide each time, I think, just give me 1 second. Meanwhile, I think, just think about what your key drivers are. I think all of you, like, I think I just want to think for a minute about what the key drivers of your business are. I want you to answer that question. What is really driving a business, or what's really driving a firm value? What are the factors that go into a firm value? I wanted to think about it. I'm going to ask about it. In between, maybe like Blake, do you have anything to add to what I said? I'm just going to like get this one working in a minute.
Yeah, I think definitely reinforce what Sudhir said. So as a VC, the one thing I know when I look at your financial model is that that's not what's going to happen. But what it does do is it lets me dive in and start to understand the basics of your business and what are the key drivers. If I am starting to ask you questions about your financial plan, you should take that as a good sign, right? A financial plan, think of it as a really detailed way to tell your story. So if I care enough to have spent time in your financial model and I'm digging in with you on that, that's a really good sign. That means I'm interested in your business. And what's great about a financial model is, you can use that model to figure out, to dig deeper on those questions. So if you're saying, I think X, Y, and Z is going to happen, you can use the model to figure out what exactly it is that the investor doesn't agree with, or what level of that detail. And then you can either address that by saying, well, here's evidence, or, hey, my model's not really that sensitive to it. Sudhir, I'll hand it back to you. Looks like you got it running now.
Yeah. Can you go to menti.com? I think this what you see on screen, and use this code finance0021, and you can actually say what do you think are the key drivers of firm value. Again, I'm not talking about just your business. I'll come back to that, and I think the assumptions. But here you think of any firm value, and because from VC you're trying to sell your business, right? What do you think drives the value? Maybe take 5 seconds. I think let me start some countdown. It's the first time I'm using this one, so probably I think we don't need 1 minute for this one. Once you do that, I think I'll get the results. This is the first time I think I'm using here in this. So let's see.
Well, there you go. It looks like you're starting to get more now.
Yeah.
Yeah, there you go.
Yeah. I thought it would be a good visualization in a way.
Yeah, this is pretty cool, Sudhir.
Thanks. Yeah, I've seen it at a conference and I liked it. I thought it's a good way of getting, I think, your input dynamically. Okay, so probably everyone, I think this will evolve, but if you think about it, so if you, again, this goes back to like, I think your financial models, right? I think as many of you say, ultimately, all of this you can boil down to 2 or 3 things, right? So what are your cash flows, right? You have your revenue top line, you just have a significant revenue, but you don't make profit. It's not going to be, don't have a plan for a profit. It's not going to be that useful. So what you want is like ultimately cash flows, right? Profitability. But you also want to think about the timing of it, when you are going to get it, because when you're trying to do any kind of discounted cash flow valuation, any kind of valuation, it's not only the cash flow that you get, but also when you are going to get, right? So that's what is going to be important. So the cash flow, growth in the cash flows, I haven't seen that, I think, come in here, but in terms of probably like people thought in terms of the revenue. So it's not only what you get today or what you think you're going to get, but at what rate are you growing, right? If you are having investing and getting a higher return on invested capital, you want to grow, you're making profit, you want to grow at a higher rate. And especially for VCs, growth is definitely important. So you want to think about cash flows, growth in cash flows, and ultimately in terms of the risk. Again, I'm boiling down all of these things from, in terms of many of them, if you think of customer loyalty. Why would customer loyalty matter, right? It matters because your cash flows are going to be sticky. So you're going to say if the customers are loyal, then my churn is going to be less. What it causes you is the lifetime value of the customer is going to be higher. So you have a cash flow. These customers, if you think about, they're always doing Coke and they're always going to buy 10 cans of Coke every quarter for the next 5 years. Then you can almost like a bond, you can actually put it in. So what it tells you is, again, you want to get cash flows, but you also want the cash flows to be like sticky. So that, and what it does is also it reduces the risk of your thing. That means you go to a VC and you talk about, I think I have this one which is very addictive and I think people are going to sign in. I have these customers, but these customers are going to be sticky because it's a network effect. Once they come in, their friends are there, they don't want to leave, right? Then basically it's going to be a sticky cash flows. That means it's going to actually be better for you and a lower risk. So bottom line, all these things in a way go back to like that, whether you can go into team expertise, whether you go to the product cost, the scalability, all of them boil down to your cash flows. You think about it, how stable are your cash flows? What are your cash flows? When are you going to get them? What's the growth in cash flows? And finally, what's the risk, right? If you have very sticky customers, customer loyalty is high, then basically like it's going to be less risky. So cash flows, growth, and risk, those are the 3 components that will come in, and which I think many of you have mentioned this here, okay? So let me like, now I want to think about, so I'm actually like going, I think, much slower than what I thought. I think the slides, again, Paul said, I think I wouldn't be able to cover all the slides, but maybe like I'll just, I'll talk through some of these things. But as Blake said, and I think as I said before, you put in all these, once you understand the drivers, right? You want to focus on them. When you make the assumptions, all these things, you want to focus on them. If you think about, for example, all of them have to be internally consistent and tied together. Your marketing, your sales, distribution. If you want to make customers, what's your customer acquisition cost, right? It's a very important factor that comes in. That if it costs $1,000 to acquire the customers, but is it scaling well? If your first customer costs $1,000, the second one costs $1,000, and this is where actually I see many startups, I think, actually have difficulty because the customer acquisition costs are not scaling, right? And if they're not scaling, then basically, unless you have a very high profit margin, it's going to be difficult. So when you make this kind of plans, I know all of you have used a business model, Canvas, right? So what you want is, again, them to be consistent, and the financials are just a way of bringing them all together in one place And as Blake said, in a way, have a conversation and discuss on the assumptions and how they go it. And they also are tied together. That means the profit and loss statement based on how much revenue you are getting and how much of the cost of goods you have, that has tied to your balance sheet, which gives you a snapshot of where your business is at any point of time, right? And it has to go back to, again, the cash flow. What's your burn rate? How much are you losing? How many every month? How are you going to sustain your burn rate? If you're going to, because this has to tie back to the cap table and also tie back to your ask. What are the milestones that you're going to achieve before you can actually go for that? Right? Blake is going to discuss more of that later, but you want to think about all of them have to be internally consistent, reasonable assumptions, and focus on the key drivers of your business. Okay. So the next one, I think, I don't want to belabor the point. This one just changed the question here to what do you think are the critical assumptions you have made? So one sec, let me I think this one, I'm going to, again, think about just for a second. I'm going to ask the same questions. I wanted to think about now, not a general model, but your own business. What do you think in your financial models? What are the most critical assumptions that your group has made? Just think about for 30 seconds, because I'm going to open it up again. It looks like I think it's going to take, it's going to take a minute, but think about that. I'm going to ask you, instead of the key drivers, I want you to think about what are the most critical assumptions, the top 3 in a way, that you have made in your own financials. I'm going to open up in a minute. And I welcome any questions so far, by the way. I'm still learning, I think, this one. Instead of the key drivers, think about what are the key assumptions you have made in your model. Okay. And also, if there's any, while we're doing this one, anyone has any questions, I welcome the questions.
And feel free to type them in the chat and I'll bring them up to Sudhir as they come in.
Yeah, I'm in full screen mode, so I can't see the chat window. So
yeah, I'll help Sudhir, no worries.
Yeah. Because the key thing is you need to know what your critical assumptions are. And when you talk to a VC and you get knocked off on that, one, if you don't know what's critical to your business, what drives it, and 2, you haven't actually thought about how to stress test that one, then you'll be in trouble. So that's why you want to really, really do a lot of work on the critical assumptions, understanding them, and also trying to see how sustainable that is, how to defend that, right? Okay, so we see some of the key drivers before, I think some of the similar things, but yeah, let me see. Has everyone completed? Because I don't want to do a 1-minute countdown, but I think we probably will close in 20 seconds. Okay, so let them come in, I think. So there are 9 people who have done it, I think, out of 16. I think, yeah, quickly, I think if you look at this one, the assumptions, what's that one thing, 2 things, if you think about these things, again, ultimately goes back to many of these are the ones which you want to actually make in your spreadsheet. In the first tab, you want to have assumptions, and then these are the assumptions I'm making. If you think about hourly usage per user, this is your assumption. You want to put that in the first tab itself, and then you want to stress test that one. So what it does is it gives you an idea of, as you change that, the hourly usage per month of your product, your app, I think you basically think about 5 hours, right? But one, is the 5 hours reasonable? How does it compare with other businesses in the same industry? How are other firms? What's the metrics that you can benchmark against? If it's more than that, how do you justify that? Instead of 5 hours, it becomes 7 hours. How does your entire financials look like? You're not able to successfully invest or have sales calls and it becomes from 5 hours, let's say it becomes 3 hours. Then how does it change your entire statements, your cash flows, your financials, right? You want to basically look at and say in one step, you want to stress test this one and do that. So I haven't seen all the financials. I haven't seen. I haven't seen this one because in a way, again, I don't have time to go through each of your spreadsheets. But what I thought is I'll give you a very high level overview where you put in. I would suggest like you put in the first sheet as the assumption sheet, the key drivers. That does two things. One, it tells the business. It makes you think through what are the drivers for your own business. And two, it also gives the VCs a way of like conversing with you and trying to see whether they make sense. How do you defend that? And the way you defend those things gives the VCs a better understanding of whether have you done your homework, are you credible, right? So that's why I think it's important to lay them out very transparently at the very beginning in terms of whatever you think is driving. So some of them might be like the assumptions, practicality. Some of this might be more of operational things. They might not translate directly into a number, but you can think about how many customers are going to use it, right? So whatever it is, you can start from a top-down kind of approach. What's the entire market for this one? What's the total addressable market? What's the segment market? And I've seen some of you do that. But now you're expecting to get, let's say, 5% of this market. Is that reasonable? And then if you change it, you don't make 5%, you get less. What would happen? Right? You want to think about it and then think about these key critical assumptions, because ultimately the entire financial statement rests just on this one. All the other things that I'll mention, I think all those things actually you can get anywhere. And I think you already know this, but everything rests on this one. In terms of what you're critically, the critical assumptions are. So I won't actually go into the other slides. I think I want to give Blake time. I thought I'll take only 20 minutes, 30 minutes, and I've taken more. So I will skip many of these other things. These slides are there, but in a way, like how you started, many of you have done it. But basically, as I was saying, you just start with assumptions and then you build everything. And then those should be internally consistent. What I would say, reasonable, be internally consistent. And some of the spreadsheets I've seen, I think I haven't seen as much internal consistency. That's why I'm saying at a very broad level. That means whatever assumptions you make in one place should tie in with assumptions in other places. So what I'll do is in 2 minutes, I'll just summarize. I'll skip all these things. And forecasting, by the way, is it's just about, again, hitting, it's hit or miss, right? It's not only for large companies. Maybe one question quickly I ask. Do you think large public firms, we're talking about forecasting for your own business cash flows. So what do you think about large public companies? And large public companies, they have their own, and they're not only the management forecast, but you have very highly paid Wall Street analysts who keep forecasting their sales and profitability measures, EPS of these companies. How often do you think they get it right? And how often do you think they get wrong? Maybe somebody any thoughts? We're talking about startup financial. Let's think about large companies, large public companies which are listed on NASDAQ or NYSE. What do you think about their success in forecasting their cash flows? Anyone?
I will say they are more accurate and more consistent in their forecast because they have a history of 10-year past data on the sales growth and everything, and they have more security on the capex which they can borrow from the market and by equity raising. So their forecast is much more sustainable and accurate as compared to startups, because there are a lot of unknown variables when we do our forecasting as compared to theirs.
Okay. Anyone else?
Can you hear me?
Yeah, go ahead. Okay, in the interest of time, let me move on. I think, yeah, so yeah, they probably are more consistent than the startups, but again, you'd be surprised how many times they actually miss that. And how many times, even with 15 stock analysts following the company, they will have the sales come down lower than what they expected. The analysts use everything from satellite pictures to talking to customers to everything. But even after all that, not only the management misses, but even the analysts might miss. So again, there's a company, I don't want to name anything, but if you just look at last quarter, I think how many companies missed their sales forecast, right? How many analysts missed it? How many surprises are? But the bottom line is, again, going back to the previous points, this is just don't expect to get a very accurate number. It's all the assumptions that you make. That's what drives it. And you want to make sure, and the assumptions might be appended just in one quarter, right? So you need to be nimble. So I'll actually skip all these things, the customer. So because the slides, I think Paul would make it available. So I'm not going to actually go into these things, but I think I just want to summarize these things.
They will have access to the whole deck in the next 24 hours.
Okay, that's good. So in terms of summarizing, I think in a way, like I think how far do you want to forecast this one? Again, going back to all the points, if you can forecast 20 years and build a very sophisticated financial model, but no one believes it, right? And it's 20 years, no one knows. And I think it's just a matter of probably like, I think maybe 3 to 5 years, I think you might want to do that because, and it also has to tie down to the milestones. I would think of it more from a milestones perspective. You want to tie the length which you forecast to the milestones you're planning and hitting. It might be consumers, number of consumers you want to get, or it might be the regulatory, you need to get some regulatory approval. That's why you want to do that. Or it might be some other kind of thing, right? But you want to tie the length of your financials to the milestones and defend and justify them. I know some of these things I'm saying in a very general things, but I have seen all of you have done the models. So there's no point in me telling you how to do the models, right? But how to actually think about, I want you to think, go back and think you are the best judge of what the drivers of your business are, what the critical assumptions are. Now I want to think about how to stress test them in a way. So all of this, again, this is a quote that attributed to Mark Twain, but I think again, as I said, it's the known risk and unknown risk. Many a time you can uncertainty, the known risk, you can actually do some stress tests, but there will be unknown risk, the unknown unknowns, right? That's what happened. No one thought of COVID as something which would come in and disrupt the entire business, right? This is completely came in the left field, right? There's known risks which you can model, which you can incorporate into your models. But what I want to suggest is, and I haven't seen in any of the spreadsheets, I want you to do simple sensitivity analysis. One is, as I mentioned before, you have the critical assumptions for your business. Then you change those critical assumptions, maybe simply changing some numbers and then seeing how does your entire business, the cash flows, how long does it take for you to be profitable? How long does it take for you to actually hit your milestones? How do they vary? That's one. And the second thing I would suggest is doing some kind of simple scenario analysis. You don't need to do very complicated scenario analysis, but you can think about very simple, what's the base case? What's the pessimistic case? And what's the most optimistic case? How long does it take for you to hit profitability in your pessimistic case? What's the burn rate? Can you sustain it? What's the runway in your pessimistic case versus optimistic case and base case, right? Thinking through those would be helpful. And just in terms of summary, because Blake's is more important, I want you to see through Blake. But again, just this is a summary of what I mentioned. Again, keep it simple. Very complicated business models, 20 years out, and I think hundreds of assumptions don't make sense. Keep it simple and transparent. As I said, you think of it as a way to converse and discuss, get the feedback of VCs, and also show them how much homework you have done. What's the 3 things that drive your business the most, right? Be transparent. And two, the financial model should be a reflection of your business. It has to be internally consistent. What you say you're going to do, how you're going to acquire your customers, has to translate again into your cost of goods sold, your customer acquisition costs, and other metrics. It has to be internally consistent. Three, it not only has to be internally consistent, it has to be externally consistent in the sense that you are going to get customers, a million of them. Many you basically are going to project them. But is it consistent with other startups have done it? Is it consistent with other large companies have done it? How long did it take, if you're benchmarking your company against Spotify, how long did it take Spotify to hit the metrics? How long did it take it to hit other companies, other public companies? Are the profitability numbers that you are expecting, are they consistent? Because you say you're going to have 200% profitability, unless you have a moat, you have a significant competitive advantage, a patent, which is going to keep you for the next 10 years, there's going to be competitors, right? Then your profitability might not be what it is. So you want to basically say, not only has to be internally consistent, but also externally consistent. And for many of the consumer facing startups, pay special attention to the customer acquisition costs. I haven't seen as much discussion in the models on this one, but this becomes the most important thing. And when there's a lot of money, venture capital is free, like in a way cheap, you can actually use $1,000, $2,000 to acquire a customer. That's what I think many of the startups, if you have seen, I think last 2 years have done. But in the current environment, I think that's going to be tough. So you want to think about special attention to that. Identify the key risk factors, some of the ones I think which you pointed out in the drivers and the assumptions, and either a way to de-risk them, either a way of collaborating, either a way of other ways you can actually showcase to the VCs that you can de-risk them. And finally, as I mentioned before, stress test the model, right? That gives you an understanding of what's driving it, how it's changing in different assumptions in a COVID world, post-COVID world, different ways. But it's basically, it gives you a better understanding of whether your business model is realistic. It still might be a fiction, but you want it to be a realistic fiction, right? You want something which you can sell the VCs and make them believe in that, okay? So in the interest of time, I'll stop here. And I think anyway, we'll discuss some of this later, I think, but I want to go to Blake and I'm open to any questions later. Okay, thank you.
All right, can everybody see that?
Yep.
Yes.
Give me a thumbs up. Okay, good, good. All right, so now that Sudhir's talked to you about building the financial model, and again, just everything he said was spot on, and building that model bottoms up, making sure you understand those dynamics, that's what's going to help you be successful in raising capital. So what we're going to talk about right now is the ask. And so before we dive in, how do you guys how do you think about how much capital you need to raise? How did you come up with your ask, or how much capital you think you need to raise for your startup? Yep. Anybody chime in?
I tried to figure out how much runway my company would need to raise my next round, and then I added 6 months additional to it, and that's how I did it personally.
And what does that mean? And how did you define when you need to raise your next round?
I looked at benchmarks for, so currently raising pre-seed, want to raise seed. So I looked at different benchmarks for companies raising seed, and generally you see about 25,000 in MRR. And so I said, okay, well, this is how much money I need, and this is how much time I need to grow my company to 25K MRR. And that's pretty much how I did it.
Yep. Anybody else?
So we need to have the what are the expense we are going to incur. So there are different heads you can take into account. What is the monthly rent and all? What are the equipments you need to build your product? And what is the SGA expense of your team, and how you are going to make that? and then you need to keep some cushion, and you need to link it to the milestone, because you cannot raise $50 million in the first go. So you need to see that first, this is the small step which I need to make. So I need $2 million to count to achieve this milestone, and then accordingly we can plan things. And then you need to have a cushion of 2 to 3 months to have a dialogue and to build a relationship with a investor, so that it get matures and then you close the round. This is how a product or hardware startup needs to think.
Great. So good. You heard a lot of what we're going to talk about just in those two answers. But for starters, so let's start out by trying to answer the question of how much capital you need to raise and when you need it, and when you need it. I'm going to sort of skip over a big question here, and that if we had all day, I would talk more about, which is, do you really need to raise capital? And is your business really appropriate for high growth capital, which is what we're talking about today, and what I gathered from the outline that Paul shared with me that this is all about. But there is a question of, should you raise capital? And we'll talk a little bit about what those sources are. But in terms of determining how much capital you need, very much what you guys just said, you have to take this financial plan you've built, which tells you how much capital you need to operate the business, and marry that up with the key milestones, and that's what drives your funding plan. So what does that mean? What is a key milestone? So Sudhir talked about how you build value in a company, and that hypothetically the value of a company is just, the value of its future cash flows. And so as an investor, the same thing. Hypothetically, the value of an investment is how much I put in and then the future cash I'm going to get out. But obviously for early stage companies, you guys talked about how they lack an operating history, right? They don't have certainty in predicting those cash flows. The way that you would do that, those of you that have taken finance classes, right? Any of the risk factors that you tried to apply to that model would just be nonsensical. So when early stage, when you think about a really early stage, the stage you guys are at, right? Just the ideation stage, creating the first version or MVP of the product, right? And getting the very early days of getting that company out to market. What really increases the value of your company is that you're reducing the risk that you're going to fail, right? So milestones are not a to-do list. It's not, hey, I'm going to get A, B, and C done. It's not just, and so one of the things you have to be careful about in some of your answers earlier is that you said, well, look, hey, seed investors want you to have 25,000 in revenue. So if you just go out there and absorb knowledge from blogs and try to pattern recognize, what you're going to miss is the opportunity for you to control your story and for you to take your financial plan and explain to that investor why these are the right milestones for you. So milestones are not just to-do lists, and they're not just accomplishments. They correlate with things that produce value externally. I'll give you an example. I can't tell you how many companies, maybe I've invested in very early, and then, a year and a half later, they run out of money and they come back to me, and maybe they were just shy of that milestone. And they say, well, look, Blake, look at all the work we've gotten done. We're almost ready to release that product, right? We almost hit XYZ milestone, but you didn't quite hit it. So from the outside, the company's no more valuable than it was before. Doesn't mean you didn't put a bunch of great work into it, but you didn't achieve the kind of milestone that makes the person from the outside say, hey, this is less risky than it was before. So the first thing you have to get right is identifying milestones that create value in your company. So one of the interesting things right now about COVID, we've invested in 51 companies and all across the board, we've seen all sorts of reactions from our startups. But when I'm talking to new companies, people have said, hey, what are you looking for now in this environment of COVID? And the answer is, I'm looking for the same thing I was before, but now I have an additional criteria, which is, if I write the check right now, it's not just will they survive for the next year or two. I want to know, are they going to actually create value in the business? Because if they're not, I'll just wait a year or two. I'll let them survive on somebody else's money. And then I'll invest in a year or two because they're going to be worth the same amount. So you have to look at your financial plan and say, hey, at what point in my business did I get to these milestones? At what point can I show the investor that I can actually build this product I'm talking about? At what point can I show them? So all these metrics that you guys hear, these are just the marketplace trying to give you a simple version of saying reduced risk. So having X number of customers is just a different way of saying somebody other than your mother, bought the product. So that reduces the risk, right? So milestones reflect reduced risk, which means a higher value, which means that your cost of capital will be lower, right? The valuation will be better. So you'll have to give up less equity. You'll have less dilution. And obviously you'll have more options and availability for that capital, the more successful the company is doing. So the farther the company goes, those key milestones, if you don't remember anything else from my portion of the investment and my portion of the presentation this morning, it's just remember to learn to think in terms of really value creating milestones. Design your plans, design your work, and design your execution around that, especially in the early days of a startup when all of the other traditional metrics like profitability and all that stuff don't yet apply. When you're raising capital, you heard him talk about this earlier in the answer to one of the questions, my seed round, my Series A round, all of those things, don't play to what the market wants. Figure out what you need. The reason we have, seed, Series A, Series B, you move on to private equity, growth capital, IPO, the reason as a company that you stage investments is not just what it feels like as an entrepreneur, which is no one will give me all the money I really need at one time, that's what it feels like as the entrepreneur. But there's actually another reason for that for you, which is by staging those investments out into multiple rounds, you take the most expensive capital you take is when you have the highest risk, right? So you have to give up. The value of your company is the lowest. And we'll talk about how we think about value. But if your company's only worth $3 million and you need $3 million, you have to give up half your company to raise that. So while your company's worth very little, you should try to raise less. So by staging out your investments, staging out your rounds, and thinking that way, not just thinking, what do I have to do to get to the next round, but thinking, what milestones can I accomplish that are going to create the most value? And what that does is that shifts risk to you as an entrepreneur, obviously, because if you don't hit those milestones, then you may not be able to raise money, or you'll have to do it at a very poor valuation. But the benefit to you is that it'll suck up less equity. You'll have to give away less of the company. And so as we kind of power forward here, I want to pause. I know the other presenters have covered this. I know this is probably 99% of what you heard about in your class. But as a VC, I cannot overemphasize enough to you that your success as an entrepreneur, not just in raising money, but period, is how good you are at telling your story. Building an early stage company is all about telling a great story. It's not just for investors. It's getting your early customers to bet on you. It's being able to convince people to come work for you, great people to come work for you. It's being able to get the partners that you need to execute. And then, of course, it's about helping the investor get excited about your business. And in telling your story, the most important thing, the hardest thing I have to do as an investor is you just cannot imagine the inbound requests that we get for capital. So one of the most important things for you to be able to do is to very quickly, your first goal when you're reaching out to investors is not to get them to invest. Your first goal is just to get them to actually put you in the pipeline of things they're going to work on, right? So the very first thing you have to do is get them to understand the problem you solve and who you solve it for, okay? Early stage entrepreneurs are notoriously bad at this, right? And Sudhir and will validate this, but you know, his colleagues and folks at technical universities are terrible at this, right? They come up and they tell me about the amazing technology they've created, how hard it was to create it, how no one else is as smart as them and could create it. They never start with, there's this huge problem in the world and I solve it. And people are going to pay a lot of money for that solution. So the most important thing is not to talk about you and all this other stuff. It's who's the customer and what pain do you solve? So there's a couple tools that you need to do really well to do that. And I know you've covered these in the class, right? The elevator pitch, right? What's the short version? Having a really good executive summary, and not thinking of it as a homework assignment, not filling out a template, but in 1 or 2 pages, can you capture my attention, right? Because if I meet you at that party, you give me the elevator pitch, and I say, yeah, sure, send me something. You know, I might have been just polite, and chances are it's going to get routed to one of our analysts or whatever. But that executive summary is probably going to be the first impression. It might be the only impression you get. And so don't think of it as a business plan. Think of it as kind of highlighting the good stuff and telling your story in a short form. The financials, Sudhir's already covered this in spades, but financials are not just important for you to in terms of planning and succeeding in your business. Think of it as a more detailed way to tell your story, right? So it helps me understand, and this is why it's so important for you to build it bottoms up. Sudhir mentioned, look, if you say you're going to grow, you know, you can capture 5% of the market. I get that so often. I get financial plans and the entrepreneur says, well, if I just get 2% of the market, we'll be this big, right? That's not a financial plan. That's not even a forecast, right? That's a, you know, it's a nice story, but it's not, it doesn't tell me anything about the activities you're going to do to build that business. So sales forecasts are not taking a look at a market and saying, how big is that market? Sales forecasts are saying, how are you going to generate customers? I want to hear you say, you know, I'm going to put a guy in a gorilla suit on the corner and I'm going to have to pay him $100 a day and he's going to wave a sign to get people to come into my car wash, right? And I think I can get 50 people to come into the car wash with one guy in a gorilla suit, right? I think I'm going to advertise online. I think I'm going to have to hire a sales force, and I think they can make 100 calls a day and get 10 leads and 1 close a month. Whatever those assumptions are, build them bottoms up. When COVID hit, get an echo, yeah. When COVID hit for our existing company, I think I've got somebody's echoing here. Okay, good. When COVID hit for our existing companies, we spent the first month getting, you know, online with all 50 of these companies and basically putting together red, yellow, green scenarios against their financials. There was so much uncertainty. There was no such thing as a forecast, right? No one knew at that point what exactly was going to happen. Some businesses were hit particularly hard. We had one company whose entire customer base was retailers. So suddenly 75% of their customers were shut down. We had others. We have a company that makes antimicrobial LED lighting, right, which disinfects surfaces. That company took off. But in any case, it was very uncertain for everybody. So we developed these red, yellow, green plans and then looked at what triggers to pull based on what information we got as we went forward. But to do that, those guys had to understand the real key assumptions that were driving their business. Financials are not something you can outsource just to your CFO. Yes, building them into nice models and tying them together with financial statements and tracking your progress against it and all of that is something you can outsource or have someone else do, but you better understand that financial plan. And then of course the pitch deck, which I know you guys are putting a lot of effort into, but what I will say, what I will take a couple seconds to say is that I get a lot of questions from students in my class and others I talk to. They reach out to me and say, can you send me a template for a pitch deck, right? And that makes no sense. Can you send me a template to tell my story? What you want to do is outline the story you want to tell and then build your presentation around it, right? One of the best ways to be terrible at telling me your story is to take someone else's template, plug your information to it, and then just sit in front of me and read it. I don't sense any of the passion, right? When I make an investment, I know I'm betting big on two things. I'm betting on the team, I'm betting on you as the entrepreneur, and I'm betting on the market opportunity. And if I don't sense this incredible passion, right, and expertise coming out of when you're talking to me, you're doing yourself a great disservice. So outline the story, make sure you cover all those things, and then build your presentation to support how you would tell the story. So you'll have this deck later, but there's a little outline, and it's almost like those bold words are what your slides should be. But you have to put your story together. Okay, so let's talk about actually making the ask and the process. So in raising capital, you know, is a process. It's not it's not Shark Tank. You don't meet once with an investor, present, and then they whip out the checkbook, right? What happens is you have to go through a process, and once they're interested, depending on who you're raising money from. So most of you at the very early stage, here's the bad news, right? Who do you think is most likely to invest in you right now?
Your parents.
Any guesses? Your parents, right? People who already love you. Yeah, exactly. People who already love you, trust you, and know you, because you're so early on, right? You guys are, in many cases, students or recent students, right? No track record. The business has no track record. You have no track record, right? So friends and family are one thing, right? Friends, family, and fools, people sometimes joke, right? That's who's going to invest in you right now. But as you get meat on the bones around your business, then you start to approach seed investors, angel investors, and then eventually venture capitalists. What's the difference between an angel investor and a venture capitalist?
Venture capitalists invest other people's money.
Right. And an angel invests his or her own money. So as you start to approach these more formal investors, when you're pulling together an investment round, the first thing you need to find is a lead investor, right? Who is actually going to corral, either write the whole check or corral the other investors? Who's going to set the terms? Who's going to set the term sheet? So once you get down to basically yes, there's a term sheet. Think of that as the engagement ring. You're not married yet, but it says, I'd like to marry you, and here's the terms under which I'd like to marry you. And then you have to pull together, usually there's more than just one investor. You have to pull together, you have to find the rest of the money. If the types of money that you'll be raising, you might be going to angel investors. So you find one guy, if you're raising, $200,000, one guy might put in 50, and he might set the terms. And then you might have to go around and find 5 other people to put in 25,000 or whatever to add up to how much you're raising. So that's syndicating the deal. That lead investor is going to do some degree of due diligence. So all the things you told me, you thought you were done because you raised all this money. You convinced me. We've talked for a month. You pitched me. I've asked you 100 questions. I called all your customers. I called your mom. I made you prove everything. So you thought we were done. But now in due diligence, I actually go do hard proof. I say, show me the contract, right? Let me go confirm this or that. So that there's a period where they do that homework. And then the documents for that round are drawn up. And then finally you close. So once you think you've raised money, once the person says yes, you're still at least 45 days probably away from getting capital in the bank. Okay? So you heard earlier him say, hey, it's going to take me 2 or 3 months to raise this money. 3 months is how long it takes if you're a rock star, right? It's going to take longer than that if you haven't done it before. Okay, so this is a long process. But let's talk about the terms and the term sheet for a minute. One of the things Paul asked me to cover was sort of what should you think about? Unfortunately, that's 4 4-hour classes in and of itself to really go through. But the one thing I want to leave you with is that on Shark Tank, it's all about the valuation. On the blogs, it's all about the valuation. In the media, it's all about the valuation. And there's a joke that VCs have, which is, I'll let you pick the valuation if I can pick all the rest of the terms. I can fix the wrong valuation with all the rest of the terms. I put in those legal documents. There is a reason that when you raise money, the stack of documents you wind up with is an inch thick. It covers all these terms. So you have to think about more than just valuation. It's both the economic terms and the control terms. So economic terms are things, in addition to valuation, it's things like the liquidation preference, right? Which means if you sell the company, I get my money out first. Or I might get my multiple of money out first. Or even worse, it might be participating liquidation preference, and I might get my money out first, and I still get my percent of whatever's left over, right? There's all sorts of terms. If just because you own 30% of the company, and if you sell it for $100 million, does not mean you're going to get 30 million. All these terms will determine who gets what money on a liquidation event. And then there's control terms, right? There's all sorts of terms in the document. So as a minority investor, right, I put terms in the documents that help control. Now, entrepreneurs sometimes, when times were good before COVID, right, people would you'd hear the word entrepreneur friendly. And it was, oh, any sort of control terms. It was an investor being a bad guy, right? You hear for venture capitalists, you hear them called vulture capitalists. And so some of these control terms were seen as abusive. But think about what, as a early stage company investor, you're doing. You're putting money into a business that's not regulated, doesn't have reporting standards, and for all I know, you're going to take that money, and go buy a Ferrari. So these protective provisions are meant to protect me as a minority investor. But they can control a lot of things that entrepreneurs are surprised about after they've done the deals, right? They can say things like, you can't make X, Y, Z decision about your business. You can't even decide to sell your business without X% approval from investors. So these control provisions are very important too. Who's on the board? All these things. So we don't have time to actually cover them all, except to say, you have to think about when you're raising money, you have to, it's not just about valuation. You want to understand all of the terms, and you need to have a really good lawyer. And by the way, a really good startup lawyer is not your sister. It's not your next door neighbor. It's not the kids you grew up with that happen to go to law school, right? That'll do this for free. You need a lawyer who does early stage financings, because all of these documents, all these terms are really important. I'll leave you with one quick thing on this one, which is if you want to educate yourself about what all those look like, a good way to do that is by going to the NVCA, the National Venture Capital Association's website. And they have some standard documents that you can look at, some template documents. In fact, as a VC, I try to follow as much as we can in our deals, those documents, to give others confidence that there's not something buried in there that they don't know about, because these documents, for an entrepreneur, these documents are so scary. So let's talk a little bit about structure, right? So, in Shark Tank, they say, hey, I'll give you X dollars for X% of your business. So they're selling equity, okay? And equity can come in two flavors. The equity you have starting the company, you have common equity, but all the things I listed on this slide, all these economic and control terms, one of the ways I make those come into effect is I create a new class of stock, a preferred equity. I have equity that has certain rights that common shares don't have. So most of the time, when you raise capital, maybe not from the angel investor, but by the time you're raising money from an institutional investor, a venture capital firm, you're gonna be issuing preferred equity, which just means that stock has certain other rights. Okay. Now, in addition to equity, what's become more popular in recent years are different convertible securities. So instead of selling equity in the company, you raise money in the form of a note or a safe, as two examples. As an investor, I'll talk about what they mean in a second, but what these convertible vehicles mean is that it's even funny when people say I'm an investor, and I say, no, you're not. You're a lender right now. You hope to be an investor one day. You hope to be on the cap table one day, but you're not there now, right? You don't actually own equity in that company. You have something that you hope, and you don't even know what you can't even answer what you're going to get. So as an entrepreneur, there's a lot of good reasons to do convertible securities. It's cheaper, right? That 1-inch stack of paper I described is only a 1/4 inch thick, right? So it's easier to document, it's cheaper. You don't know yet how much the company's worth. You might be raising money from your mom or your dad or someone else. And there's no one in that conversation has the ability to even begin to think about having a valuation starting point or knows how to start setting that. So there's a lot of good reasons to do it. But the one thing you have to be careful about, or two things you have to be careful about. Number one is, as an investor, I don't mind doing convertible debt in the companies we invest in once I'm already an investor. As a bridge, it's a very good way as a bridge note. Let's say we all agreed we're going to invest, $100,000 and you're going to achieve these milestones, and you didn't get there. So I'm going to help you get there before we raise more money. It's a good way to bridge when you run out of runway. I don't love it as a first investment. We do it sometimes, but I don't love it. And the reason is now all of a sudden we're not aligned, right? So I'm married to you, right? When you pick an investor, it's a marriage, right? In fact, it's stronger than a marriage because it truly is till death do you part. There is no such thing as a divorce. You have to exit me to get rid of me. You can't walk away. And so now we're married. And now I'm rooting for a low valuation and you're rooting for a high valuation, right? So we're just out of alignment from day one. So I don't love convertible vehicles, even though they make sense sometimes for entrepreneurs, especially in the very early stages. And the second reason that I don't love it is because angel investors always do so much convertible debt and we invest in early stage, we're usually the first institutional investors. And so then I wind up meeting with you, right? We're talking about a valuation and you think, oh, he's going to invest, $1 million on a $3 million valuation. So he's only going to get 25% of the company, but you've already raised $1 million in convertible notes. So then when we sit down to do the math and you find out that $1 million now has to convert and it's not only 25% of the company, you're giving away, 30 or 40% of the company, you get mad at me, right? And it's not my fault, right? You pretended you hadn't sold the company before, but you had already sold those shares. So what happens is when you do raise money in the future, all of that, you're basically just kicking the can down the road. All of that's going to convert into equity at some point. So you're going to have that dilution at some point. So it's kicking the can down the road. There could be good reasons for that. We don't have time to totally go into the difference between the convertible debt and the SAFE. The convertible debt is as it says, it's structured as a note, a debt, a lending vehicle that will convert into equity upon certain conditions. There's some things that suck about that for entrepreneurs, right? Debt by definition has to have maturity and it has to have interest. And that's really hard to put on a really early stage company. If you get to a point and you can't raise money, what happens? So that's why a SAFE was created. And a SAFE, when I want to be cynical, I joke and say a SAFE is a pinky promise, right? It's a piece of paper that says, I'm going to give you some equity one day under these conditions, maybe. It's a really bizarre to me that it has taken off like it has. Again, certainly it's very friendly for the entrepreneur. It's a tough swallow for investors, but angel investors, it's fine. So I think the short version there is when you sell equity, you create alignment. When you sell notes, you do save money, you save time, it makes it easier, and you can solve some of the problems I talked about. You can put a cap on that note, a valuation cap, et cetera. So last thing I want to talk about, and then I think,
what is the difference between convertible debt and SAFE? Because both are putting a cap on valuation or a discounting on the next round of valuation. So how does it differ on a very high level?
Well, there's a bunch of differences. For the entrepreneur, you're right. The effects are essentially the same, right? Assuming the same terms, whether it has a valuation cap or a discount. A SAFE, there's two things a SAFE does not have. It does not have a maturity date, and it does not have a interest rate. And so what that can mean is that if the company, for example, doesn't hit that in a convertible debt, you have to write down and define and agree up front what's going to happen if we get to this maturity date and I can't raise money, or I haven't made enough progress, or I don't have enough money. So that can put the company at risk. With a SAFE, as an entrepreneur, you really don't have that risk. Now, if you flip it over as an investor with convertible debt, you know, I'm at the top of the stack. So let's say this thing doesn't work and you fire sale it, right? You find somebody to buy it, you know, acqui-hire you or whatever. You have to pay me back the debt. I'm at the top of the stack. It's true debt, right? It's on the balance sheet. A SAFE, it's not really clear as an investor if I actually have any legal recourse or any standing, because it really, you know, again, I'm exaggerating, but it really is just a piece of paper that says, if we happen to manage to raise money in the future, you know, you'll get to participate at these terms. So as an investor, a SAFE is a far less, it's an interesting name, but a SAFE is a far less safe vehicle to invest in. But as an entrepreneur, look, I think especially amid COVID, other than like a Y Combinator program or maybe less savvy investors, especially this also depends on the region you're in. You know, it's going to be harder in this environment to get a SAFE note, because as an investor, I got lots of good options to invest in right now. I don't need to choose the worst vehicle. I'm probably going to choose either equity or a convertible debt. And by the way, you don't always have the choice. You can say, I want to raise money at this valuation, but when entrepreneurs tell me that, that's fine. I do my homework, but the truth is I come back and offer them what I want to offer, right? So I may say this, I know you wanted to raise a convertible note at a 10 million valuation. That's nice. I'm willing to give you a term sheet for $1 million on a $3 million valuation. Are you interested, right? So just because you say you're doing it doesn't mean that's what investors are going to offer you.
And is
but I think for you,
debt,
I think for you guys, oh, go ahead.
Is convertible debt investor friendly, and for a hardware startup, how useful the tool is?
Yeah, I mean, the most investor friendly is equity, no doubt. But for angel investors, convertible debt is investor friendly if it's structured right, yes. As a venture capitalist, I don't love it because I have an investment thesis. I want to own a certain percent of the company. I need to do the math. And so when I have convertible debt, I don't know how much equity I'm going to own in the future, right? If you say, hey, you're an investor in that company, I say, really, how much equity you own? Well, I don't know yet. It depends on how much, you know, what the valuation is of the next financing. It depends on the discount rate, and it depends on whatever the valuation cap is. One last note, and then we'll shift back to the conversation in the breakout group. Really quick on valuations. Valuations are less about truly valuing the company and more about investors figuring out how much of the company they need to own in order to get the return that they want. And so you guys have probably covered this, but you're going to hear the terms pre-money and post-money valuation. Don't get confused by that. Pre-money means the valuation of the company before the money's put in the round. So if you're raising $1 million and it's a 3 million valuation, the pre-money is 3 million. You add the 1 million, and the post-money is 4 million. But when you're negotiating, talking about pre-money and post-money really matters, because let's say you talked about only post-money and you were going to raise $1 million, and then the investor comes to you and says, hey, my buddy wants to invest too. He wants to put $500,000 in too. All of a sudden, the post-money didn't change, but you're going to take more dilution. So pre-money is a little easier to talk about. Investors sometimes, but I will say, if you have convertible notes, I'm only going to talk about post-money because I have no idea how complicated you've made this equation, and I don't want to have to try to calculate all that. So I talk about post-money. You know, the way we think about valuation, just real quick, is, as we talked about earlier, as you decrease in risk, you become more valuable. We look at comparables. So we identify other companies in the same space, at the same stage, and look at how those companies are valued. The real way we do it is we work backwards. You'll hear the phrase VC method. We work backwards from the return that we think we need to get. So we estimate what we think is going to happen in the future. and say how much of the company do we need to own today to get the return we want. And then we may build out basically decision trees and say, well, if this company goes on to raise money, or if it fails, or if it, sells after one round of financing, sells after 2 rounds of financing, we kind of build those scenarios that we're working backwards from, and we might use different weighted averages. But when we're thinking about valuations, we do all of these different things. But all you really need to understand is that we're not actually trying to figure out exactly how much your company is worth. We're trying to figure out 2 things. What valuation can we put on this company and get the return we want? And what valuation will you say yes to? If those 2 overlap, right, we invest. If those 2 don't overlap, we don't invest. Okay, good. So I know I flew through that, but I wanted to leave us 10 or 15 minutes for this exercise. Then I think at noon we're going to take some more questions. So Sudhir, you want to jump in on the exercise, and then we'll come back and do kind of a combined Q&A after the exercise?
Sure. Paul, what do you think of the time? I think probably we are slightly late, but I think it's okay, right? I think we can do the exercise and yeah, actually, okay.
Yep, Paul has put the assignments together, so the rooms have been created. I just need to open them up as soon as we're ready to put folks into the breakout.
Okay. So what Blake and I thought would be useful is, one, to give you practice, but also I know it's a very short time, I think around 10 minutes, where you need to present to each other, but focus on if you look at the screen, what are the critical assumptions in your financial model, as you talked about, how much are you raising and why, and what's the capital for, what are the milestones, and how do you plan to raise it? All these are similar to what I think I mentioned earlier and what Blake has said in his presentation. So in a way, we want you to take that and pitch to the other company. When we come back in, and what I want is have 10 minutes or 15 minutes. Initially we thought we'll have the other party come and discuss it, but there's not as much time. But what we will ask is you don't actually put in information about your own group, but put the information about the other group which you heard about. Because we want to see what you found most convincing and what you found less convincing. And if there's something based on this entire exercise, you would do a bit differently in your financials. So that way, maybe we can have, I think that one we can devote around 10, 15 minutes. We can answer questions during the time. So those things would be useful. The plan is now you go into your own breakout rooms, the 2 teams in each one, and Paul has created that. And then 5 minutes, maybe each, you present to the other team about your plan. And then you come back up after 10, 15 minutes. And then we discuss, maybe in the chat window, you can put in this information. And we discuss about what's there on the slides in terms of what you found convincing about other companies' pitch. And what are the things that you do differently. And what requires work in the other company.
Yep.
Okay?
And then before...
And I think on the pitch, pitch might be, rather than doing the whole pitch, I think what we're really suggesting here is that you share what kind of what your ask is, right? How much you're raising and why, and what you think you're going to accomplish with that.
Yep, agreed. And I think Paul is going to clarify some instructions, because obviously we have, a lot of team members in a couple of the rooms for the 2 groups. So Paul, do you want to clarify any instructions before I open up the rooms?
Yeah, if you have multiple team members, basically just asking the team captain to talk to the other team captain. Only one room is really big.
Okay. All right. With that, I'm going to go ahead and open up the rooms. And the rooms are open. You should see a request to join the room. So please go ahead and enter the room. And if you don't see the request, it's going to be at the bottom bar of your Zoom. You'll see the dots to open up the expansion, and you should see the request there. And Blake, Sudhir, Paul, you guys are going to stay back.
Yeah.
I have not assigned you to any of the rooms. And again, those that are not seeing, or I think there's a few folks looking in, Tyler, you should see the ... in the bottom bar, we should give you the request to join the room. All right.
And
Smiley.
can Blake and Sudhir move between rooms?
I can
Can
put
you
them
make
into
them
whichever
co-host to do
rooms I
that?
want. Yeah. Yep. Very easily. Okay. Gents, looks like everyone's
back in 12 to 15 minutes. Yeah.
Yep. So everyone's in the rooms now. So we're just sticking back right now. So let me know, Paul, if we want to bounce folks around to rooms. I'm happy to go into a room as needed too. So just let me know.
I think let Sudhir and Blake do that.
Okay. So
and you just make sure that there's conversation going on.
Yep. So to make this easy, guys, what I'm going to do is I'm going to rotate you guys every 5 minutes to a different room, if that's okay. Is that going to be okay? I don't want to. And the thing is, what's going to happen is that once I move you, you're just going to be moved into a new room. So I'm hoping that I'm not going to do that mid conversation.
Every 5 minutes.
But
Sudhir and Blake. Yeah.
Yep. So I'm going to go ahead and do that now. Sudhir and Blake, I'm going to go ahead and start putting you into room 1, room 2. There's 5 rooms total. And then one of you guys, I'll just place it to an additional room.
Okay.
All right. Putting you in rooms now. Blake, go ahead and accept. Sudhir, go ahead and accept.
Sudhir, I don't know if you have any comments from what you looked up.
No, I think very quickly, I think all the groups have done a good job. I think I was bouncing around, I think 2-3 rooms in terms of pitching. But again, I echo, I think what Blake has said. I think in a way, you're trying to sell a story, right? I think you're trying to put somebody, give them money to you, and you have to show them a vision. So what it would be if they give you the money, where it's going to end up to be, how good it's going to be. That's one thing, in a way, telling the story with in a reasonable way. That's one, I think I would say probably need some improvement in a way, because you want to be excited about your own thing, and your excitement and it has to be infectious, that the venture capitalists, others I think are also excited about passion, right? Team, I think that's one thing I think that's there. If the money comes in, it's going to be will lead to this great company. And the second thing again is some of the assumptions in a way, I think when you're trying to convey, I think again, it's a short term, I know. But I think the same thing, I think, is when you meet a VC, you're doing elevator pitch. It's not that you're going to get a long time period to explain this one, right? So I think maybe tightening that up a bit and focusing on what the key ingredients, I think, of your model, what it would do to get to those, what are the key milestones, and what does it take to get there, and how you can de-risk some of them. In other words, I think that's, another thing, I think, which there's some discussion, but not as much. So what would be useful is maybe I think in the chat window, maybe I think some of you can put in what the learning, I think if there's anything, before we go to the next questions, in a way, when you heard about the other company, not on your own thing, but maybe you can put in I asked, I think, what did you feel about the other company, what they could improve, or I think what would you need more feedback? And 2, is there anything you wish that you had done differently based on listening to another person presenting their work to you? Maybe you can put those 2 things in the chat window. One, in a way, what you felt, I think, what you think about the good and weak points of the other presentation. And 2, I think, what, if you wish anything you would have done differently, having listened to some of these other pitches. So if you can put those things in the chat window, maybe we can, because there's not probably as much time. Initially, we thought we'll ask, I think, just to present in the other pitch in 2 minutes, but there's not as much time. So it might be useful just to put it in the chat window. We can discuss and then go to Q&A. Is it okay, Blake? I think we'll do that way.
Yeah, I agree. I think sharing in the chat room. I think probably given the time, I think moving to Q&A, make sure we give them some time to do that. So maybe take a couple minutes and just make any notes in the chat room about your observations about the other teams, as Sudhir said, and then let's dig into questions.
And perhaps with the interest of time, we can do both simultaneously, right?
Yeah.
Run them in parallel, put stuff in
Yeah, I
the
agree.
chat
Why don't we just? Yeah. So why don't we, if you have any thoughts, put them in the chat room, and then if you guys, chime in if you've got questions. Paul, I don't know how you guys usually do this, if you have people raise their hand or just speak up.
We've done it both ways. The group's small enough to where we can certainly take either way. So, anybody got a question? If not, we'll call on you to say something or do something, right? Maybe we'll ask, is there somebody here, a team that's actually raising money? So I know the team Ambi is. So Sharik, I'm going to call on you. Maybe give us some views of what you heard today or what question you'd ask that might be different than how you were planning as of yesterday to raise money.
Oh, I have a huge amount of questions. Initially,
ask your most important one because we're going to keep going. So.
Sure. So I put this in the chat as well, but my understanding is that very early stage pre-seed fundraising is meant to figure out like marketing and sales channels, iterate product, find product market fit. And that's very zigzaggy. You don't know very well how the results of your channels will be. And so my question is, how should we effectively project growth in our models when my job will be to test email campaigns, social media ads, SEO, cold calling, walk-ins, strategic partnerships, referral programs, etc.
Yeah, great question. So I'm going to make two comments. One is, how do you test something? Right? To test something, you have to have a hypothesis, right? You have to have a starting point. You have to have something you're trying to figure out, based on what you think is true. So in general, if all you're doing is gathering information, that's not something, you probably need to be doing on other people's money. It's when you start to execute on that, right, that you're probably going to need that money. And the second thing I would say is that what I do is I build into our plans. When you're scaling companies, big companies do the same thing, by the way. They don't know which of their advertising campaigns are going to work. They don't know which of their new product launches are going to work. And so what they do is they build a portfolio of activities, right? And make certain modest assumptions about those coming through. So when we run marketing experiments, we're almost always running 2 or 3 at a time in hopes that one works. And then the one that works, we just keep doing it until we've basically bought all the customers we can buy through that experiment, right? And then we stop doing the other 2, and then we add 2 more new experiments. So that is something you can, roughly model, because you can start to talk about, this is the assumptions around the cost of the customer I'm going to acquire. So you're going to say, I'm going to spend $10,000, on Google AdWords to find out if that works. I'm going to spend X thousand to find out if that works. But yeah, you have to go ahead and project through some, aspirational or hopeful assumption that some of it's going to work, so that you can know what to measure against. What cost of customer acquisition do you need? You can't just spend money and say, well, I got 2 customers. You need to know if that's good or bad. 2 customers for $10,000, is that good or bad? I don't know. What kind of product are you selling? How much are you selling it? So think of you as modeling the experiments you're going to run with some assumptions around some degree of success that you have to have and benchmark against.
Understood.
I think just only thing I would add is, I think, again, every company would do the A/B testing always. So you probably want to pick, I think, a few and I think test it out. And then basically based on those things, based on my trial run with these things, this seems too promising. So we are going to go for those first. And then if more money comes in, you're going to switch to the remaining ones. It's on 2 dimensions, right? One is in terms of how much efficiency and the cost. If it takes $1 million for you to get something, it might not be worth at this stage. So you might want to look at on those 2 dimensions and go in a sequential fashion.
Okay. A couple other questions, then we'll start wrapping up in 5 minutes.
if it's appropriate, then I will request Scene to give the feedback as the breakout session end without listing the feedback from the opponent team.
You
Yeah, I
want to
was
go
actually-
first, Prakash?
You can put in the
You go
chat
first,
window.
Prakash.
Yeah.
Yeah.
I have a question
Anyone else
regarding
have any,
term sheets.
did he have any questions?
Yeah, Blake. This is Shant here. So what should we offer capitalists? Should we offer both convertible debts and SAFE, or only the preferred ones?
Yeah, there's no right answer to that question. So there's two scenarios, and a lot of it depends on who you're raising money from. Sometimes you have to set the terms that you and go out, especially when you're pitching to angel investors, and say, I want you to invest in a convertible note, you know, and at this valuation, et cetera. But you know, a lot of lead investors, you know, if you came and pitched me and I got interested, I don't care what you tell me you're doing. I'm just going to wind up telling you what I'm willing to invest in. I'm going to wind up giving you a term sheet. So there's no right answer to what you just asked. It depends on who you're raising money from. When you're really early, I think you know, it does not make sense for you to go spend a bunch of money with a lawyer until you find someone willing to write you a check. So I think it's more important to get out there and say, I'm looking to raise this much money. And then if that person says, I'm willing to give you that money, and you say, what terms? And they say, I don't know. I don't know how to do this. Then you can go back and say, hey, how about we do a convertible note at these terms? Or how about, you know, I sell you this much equity for this money? But professional angel investors, sort of lead angel investors and VCs, they're in general just going to give you a term sheet. They're going to decide their own terms. So there's no right or wrong answer for what you just said. I think you should be honest about what you want. If what you really want is a convertible note, then tell people I really want a convertible note.
Is the better answer to that question something like, I'm just going to let the market decide? Or is that a trap?
No, I as an entrepreneur, that's when people would say, what valuation are you expecting? I would say, yeah, you know, we're going to try to let the market decide. But look, you know, it's not my first rodeo. I promise you, I'm going to keep asking the question until I get some information out of you. So people are going to pull it out of you. And so I think it's fine for you to talk about what you hope for, right? And why you hope for that, right? We would like to do a convertible note because we think A, B, and C. We think a cap of this amount is reasonable because we think this is what our next round is going to look like, and it'll be good for you and me. You know, I think, you know, I'll be happy if the valuation is in ABC range. But yes, to the degree you can avoid giving that answer, especially with venture capitalists, you're better off. You're better off saying, you know, letting them give you feedback. If they do keep pressing, tell them that just say, hey, look, I need to go do some homework on that. I want to be reasonable, right? I care more about who I'm going to work with than the terms. You know, you can do a lot of things to tell them, you know, that you're ready to listen to them.
Blake, one question to you, that what Smiley had given you the answer that customer are the one who is going to finance. That is what every entrepreneur want. But when you are going for some hardware product and you need some substantial money to actually build the product, to do multiple iterations and then to certify it, and then only you can go and sell, and then only you can have your first paying customer. Then how do you think are the ways to get the initial soft cost which does not generates into revenue, so that for a hardware product you can what are the good ways to do the initial fundraising?
Yeah, so look, this isn't what you want to hear, but capital intensive businesses where you have to spend a lot of money before you find out if you've reduced the risk are harder to raise money for. That's why it's so hard to raise money, for example, life sciences, right? It takes many, many, many years, millions and millions and millions before you find out if that drug is going to work or that medical device. So those are hard companies to raise money for. It takes exceptional teams to raise money. Hardware is somewhere in the middle because it's more capital intensive. You have to take more risk before you find out if you've lowered the risk. But look, I think number one, you have to come up with a plan, a go-to-market plan that lets you take some of the risk off the table. So your initial rollout might have to be modest in size. So it depends on, I would have to know more about your product, but you can find early stage investors that will invest in that early R&D and that first set of customers, help you get through those first set of customers. Depending on the industry you're in, there might be ways to finance some of that production. You can get the orders first, but the best advice I can give you is the way to raise money is to go get the orders before you spend the manufacturing money. And the more certain that you will eventually get the money is, the easier it will be for you to raise the money from investors or from other source. So if you've got customers that have committed to buying X amount over time, you'll definitely be able to find the money. If you're saying, I'm going to go manufacture 1 million of these, put them on the shelf, and then I'm going to start selling them, you're going to have a harder time raising money.
Thanks, Blake.
And Blake and Sudhir, if you can wrap up or take one last question in the next three minutes, we got one closing poll and closeout comments. Or if there's no last item,
question.
Yeah, go ahead.
So there's one that actually came in through the chat.
What does the investor look for when someone is asking what are the preparation one entrepreneur needs to do when he is going to ask for a couple of $1 million to a VC fund or whatever? Yeah.
Akash, I think Sudhir's reading the question in the chat, and I think he'll get to yours directly after.
Okay.
Blake, you want to take this one, I think? The question in the chat window?
No,
I think it's no, actually, no, the question I think they just asked it. Yeah, go ahead, yeah. No, this one, chat window, I think it's okay. I think the question just asked, I think probably it's—
Tyler, go ahead and ask. Go ahead and ask. I know you typed it out, but go ahead and ask.
Oh, wait, sorry. Could you ask, what was I supposed to do here?
You just typed in, sorry. It was a comment. It's not a question. My bad. I'm sorry. I misread.
Yeah. So what was, maybe somebody could summarize the other question for me? I didn't totally hear it.
Akash, go ahead.
Yeah, I was asking that what is the viewpoint of an investor when someone is asking $1 million from any investor? What is the preparation investor is looking for in the company?
How much equity does an investor want?
No, the preparation the team has done on the product side, on the traction side.
Yeah. Again, there's no one size fits all to that. It depends on the stage company you're at. What I look at is, I'm looking at, so first of all, what I don't put much stock in is a company that comes to me and they have a great PowerPoint, but they've actually done nothing. And they say, as soon as we raise this money, we're going to start building this company. you know, I don't tell them this, but I instantly, you know, they get moved to the no column in our CRM, in our pipeline. So what you want to do is you want to have as much evidence of momentum, you know, as you can. So if you're coming asking for $1 million, you know, what I want to see is a really good plan. And so I'm going to have to believe in the market opportunity. So the more homework you can do for me on that, the better. I would love to see any evidence that you can build the product, that customers are going to buy it. So whether that means you already have early customers or you've got people that you're working with. And I want to see you having thought through a real plan and a roadmap. I want to understand what the product roadmap is, so that I can go talk to people in that industry and say, hey, are these really the things that would solve your need? So your product roadmap is really important. And then again, I want you to be able to tell me a really specific story around, if I had $1 million, this is what I'm going to do with it over the next, you know, 1 or 2 years. This is what the company will look like, you know, based on that money. You know, we'll finish this product, we'll prove this, you know, we'll reduce the risk, we'll make the company more valuable. And then I'm going to look at it and decide how much of that company we need to own. I'm going to look at all the other things you're going to have to do beyond that and decide how much of that company we think we need to own right now for that amount of money in order to succeed. So in terms of preparation, it's the 4 tools we talked about telling your story. And it's about having a really, really, really good product roadmap and about having a really good, clear articulation of why I should invest now and not just wait and invest later.
Thank you.
Great time to close out. I think we're right there. So we got a minute or two, Blake and Sudhir.
Yeah, I think from my side, I think again, I enjoyed all the projects. I think they're very interesting. So again, just to summarize, I think be passionate about what you're doing in terms of, I think you're selling a vision for the company, like Blake said, be passionate, be prepared. So I think, you know, like, I think all the inside and outside of, I think all the assumptions, I think everything that you have done, I think the more prepared you are, the better it is. So again, good luck with everything. And yeah, happy to answer any questions later. I think if you want to, you can connect with me on LinkedIn or send me an email. I'd be more than happy to answer questions in the future. Thank you. Blake.
Blake?
Yeah, likewise. I think we Paul's going to share with you the slide deck. It's got my contact information in it. Good luck. I loved hearing. I wish we had more time to hear more, but I loved hearing a little bit about it. Love seeing a Georgia Tech team in there. In addition to teaching there, I'm a Georgia Tech alum. So great job to everybody. Congrats. And look, I think what I'll leave you with is building a company is not a homework assignment. And this program, all the blogs you read, all of this, a lot of experts come and tell you what they think you should do. And it feels like learning and there's a right answer and there's a wrong answer. Your job is to listen to all of us and figure out which of that information can help you. But ultimately, this is your thing. You've got to build it. You have to make the decisions. And there's not a right or wrong answer on how to do this. Your job is to filter through all that advice. So for those of you that take this to the next step and truly try to build companies, you know, you've got I'm guessing on Sudhir and Paul's age, but you know, all the success I told you about, I never had to get up on stage and pitch, you know, do a 5-minute pitch or anything like that. I've never had to do it yet. I'm here telling you how to do it. That wasn't how you raised money when I built my companies. But the reason I tell you that is just to say that you should absolutely listen to all these experts. But in the end, you have to figure out the right path for your company. And so take all that advice, you make the decisions. Everybody's counting on you to make that succeed, whether it's the investors, the people you hire, right, your customers. and you have to figure out the path. And it may not be what you read on that blog last night. It may not be what Sudhir and I presented to you. You have to figure that out.
Well said. And we got a couple more workshops, and sorry, Tyler, Blake's not one of the judges, so he can't put his finger on or his thumb on the scale for Georgia Tech.
Right.
And with that, I'm going to ask, stay on a couple of minutes. We're going to close it down. We're coming in for landing. And in that regard, I'm going to ask Amin to turn the poll on at the very end, and we'll then close out. If there are any final questions, put them in chat. But we're asking all the participants to please answer the items that are on the view graph here. So we know how helpful, and we've got, actually it turns out, Blake, and so there, next week we've got a guy who's writing a book and has interviewed notable parties. He's going to present the how to pitch and how to answer questions, how to do an elevator pitch. So he's from the UK and one of our charter members and a president of the chapter there. So very well timed, etc. And I have to tell you that so far, we're going to show you the scores, and I have to tell you that you've done exactly what I challenged you to do. Last week we had a 4.84 scale on a scale of 5. I think I'll have to work this out, so whatever 94% works out to be, that people learned something, took away something. And here's what I tell everybody, you know, if I gave you a gift of a great electric drill and you stuck it in the garage and didn't build anything, then it's of no value. So the real value of what you heard today from Sudhir and Blake is take a couple of things and use that electric drill. Use it to make your business plan better. Use it to make your story better. Use it to make your financials deeper. And if you do that, then that electric drill is truly valuable to you. Sorry if I'm using a somewhat male chauvinistic example, but I have to tell you, in our house, my wife uses the electric drill rather than me. So with that said, thanks so much to Sudhir and Blake, and we'll see you all later on in the week. Thanks so much for spending part of your weekend with us.
Thank you.
Thank you. Good luck to everybody.
Do that.